Climate change is a scientific and an economic reality. The amount of carbon dioxide in the atmosphere has grown by 40% since the Industrial Revolution, causing the Earth's temperature to rise. That in turn melts glaciers and ice sheets, raising sea levels. The warmer atmosphere holds more water and contains more energy, increasing the likelihood and severity of hurricanes, typhoons, and other extreme weather events, while the combination of higher temperatures and shifting rainfall patterns decreases crop yields. Investors, however, can no longer ignore the risks or the opportunities that climate change creates for the companies in their portfolios.
There is a natural greenhouse effect whereby we have a thin atmosphere around the planet that is what stops it from being a cold rock floating in space. This is basically what allows the planet to trap the heat from the sun. And up to a certain point, that's good. As I said, it makes this a habitable planet. What we're doing is we're injecting a lot more of that in, and we're trapping more and more heat, and we're essentially energizing the atmosphere.
Climate change is really what we refer to as climatic disruption, which is the increased volatility of our weather systems over longer periods of time that have shifted from somewhat stable climate regime into one that is now highly uncertain.
You know, I think not only investors, but really a lot of people in influential positions, political leaders, don't understand the gravity of this risk, and there are a lot of reasons. It has been perceived as a longer-term risk. It's been perceived as a risk that in many ways it's been perceived as a risk, and let me just say this, it's not a risk, it's an inevitability.
Investors today need to prepare themselves for an uncertain climate in the future. What that means is that there will be changes in the way our economy absorbs the various climatic impacts, such as increased rainfall in some areas, increased drought in other areas, other vectors such as diseases, insects, pollination.
I think climate change does impact the way we should think about companies in virtually every sector. It turns out that 60% or so of most corporations' carbon exposure is in their supply chain, which is why they should audit their supply chain. Many of them are now doing this and look for ways to reduce. So it really is a wide-ranging opportunity. It is not a niche, and I think that's part of the misperception has been that that's a niche as opposed to something that generalist investors should be taking into account in all of the investing that they do.
Investors care about climate change because it has a dramatic impact on valuing of assets. If there's a weather event, then you might have a change in daily market prices. But climatic disruption is a much longer term frequency of events where these pernicious impacts don't necessarily get priced immediately. However, when they do get priced, when the market recognizes a price differential, it will close quickly. You don't want to be invested after the repricing, you want to be invested prior to the repricing.
One of the challenges of climate change is that it's currently in what we would call the uncertainty realm, which is much harder to measure, and investors don't make investment decisions when there's a tremendous amount of uncertainty available. But if you can find a way to model that uncertainty now with the data sets that are becoming available, climate data sets that are becoming available, and a lot of good work that a lot of interesting companies are doing using that big data, open data, you are able to do some modeling that can migrate the risk understanding from the uncertainty bucket into the risk bucket.
We are in the age of big data, and investment through the lens of climate change is no different than the big data world. Organizations like the Sustainability Accounting Standards Board are helping foster that along.
SASB's objective is to improve the signal to noise ratio and really focus in on the specific sustainability related data as it pertains to certain sectors, and really get agreement between two parties, the issuer and the investor.
On the positive side, there are entities like the Carbon Disclosure Project that have gone out to evaluate the kinds of investments that companies are making to mitigate climate change vulnerabilities, and also to invest in the efficiency opportunities that they present. Their last report, an annual report, found they looked at about 1,000 projects that companies had invested in, and they found that the IRR, the internal rate of return on these, was about 33.6%, which is far above the cost of capital of 8 to 12%. So very, very substantial value creation, value capture opportunities that these companies were capturing.
Investors today can take advantage of superior corporate management for enhanced financial returns. We did a study with the Carbon Disclosure Project, known as CDP, that showed that those companies who are the most effective at disclosing and engaging around climate change have much stronger financial performance. Their return on equity is higher, their dividend yield is higher, and their cash flow stability is higher. So if investors are truly looking at the financial quality of companies, those companies who are much more evolved, much better management of these corporations will see better returns on their investment.
How are we going to implement an environmental strategy that makes business sense for us as a firm? When you look at projects on an individual case-by-case basis, you limit what you do. Think about an investment strategy. It's a diversified investment strategy. And we've been able to save about $55 million in operating costs over the last 5 years through this project. My boss and I, Peter Grauer, he's the chairman of Bloomberg LP, we used to have a running back and forth where he would say, you know, we're implementing sustainability solutions at the corporate level because we think it's the right thing to do and it makes good business sense. And I used to implore him to please say it the other way around, that it makes good business sense and it's the right thing to do, because you're going to keep your audience through that first phrase, whereas the right thing to do is much more personal and defined differently by different people.
Climate change is not only a regulatory issue or a science issue, it's an investment issue. At the core of every fiduciary's duty is to understand the risks and opportunities in their portfolio. Looking through the lens of climatic change or climatic disruption is not only an important investment tool, but it's also one's fiduciary duty.
Part of the challenge is how do you engage people emotionally and viscerally in understanding this and actually ranking it as a much more urgent issue. Years of Living Dangerously is a 9-part television series that's going to air on Showtime starting in April. We are attempting to put a human face on the issue of climate change and on the impacts on real Americans and those around the world. We've enlisted celebrity correspondents, Hollywood storytellers, as well as very serious journalists from 60 Minutes and the New York Times to work together to tell this story in a I think, a high-impact way.
The economic case is there. Bloomberg LP is an example. The question is, can we bring it, make it consumable to the public, to the business community, to policymakers as well, to be smarter about how we tackle these challenges and how we create, by tackling the challenges, that we do create opportunities. You have to make the economic argument. It's no accident that I'm sitting here in a pinstripe suit because underneath it all, I'm a hippie at heart, but in the end, it's about the business case. It's got to be about the business case.